Hello and welcome to the Tax Roundup for August. Inside this month, we're going to take you through the raft of tax and superannuation changes that have been introduced to Parliament. Some of these are things left over from the last term of government, but also some new things in there as well. We're also going to look at the tax treatment of compensation payments from financial institutions. But first up, Michael Carruthers is going to take you through the FBT treatment of ride-sharing services like Uber. Across to you, Michael.
Now, the introduction of ride sourcing services into the market creates some interesting tax challenges, and we've seen some of that play out through the courts and also through ATO guidance over the last few years. What we've had this month is the ATO come out and provide some clarity on its view around how ride sourcing works from an FBT point of view. And the reason that that's relevant is because within the FBT system, there is a specific exemption for taxi travel between home and your place of work. And the question is, does that encompass things like Uber and other ride sourcing services as well? Now, the ATO a couple of years ago released a discussion paper or consultation paper saying that they were revisiting this area and basically wanted to get some input from outsiders in terms of how that FBT exemption should apply. We've seen the courts say that basically Uber and ride sourcing services are basically taxi travel from a GST point of view. But that doesn't necessarily mean we get the same outcome from an FBT standpoint because the legislation is worded slightly differently. Well, what the ATO has come out and told us is that they don't believe that Uber and other ride sourcing services are taxi or taxi travel from an FBT standpoint. So while they might be treated as taxi travel from a GST point of view, and that has implications for registration, they're not within the scope of the FBT exemption. Now, what that means is that where employees take a taxi home from work at the end of the day, that can be completely exempt from FBT under a specific exemption. Where that same employee travelling the same distance and direction catches Uber instead, well, it won't be exempt from FBT under that specific exemption dealing with taxi travel. However, that doesn't necessarily mean that it's not exempt from FBT, because within the FBT system, we have a minor benefits exemption, which can apply where the benefit is less than $300 and is provided on an infrequent and a regular basis, and where it would be unreasonable for FBT to apply to it. So where employees are taking Uber trips home from work or to work in the morning, and where that happens on an infrequent basis and the amounts involved are relatively small, both per trip and across the FBT year, it may still be possible to treat that as exempt under the minor benefits rule, but it will require a little bit more analysis. Whereas where it's a taxi being used, there's a straight exemption regardless of how often it's provided. It could be every single day for the year, it can still be exempt from FBT where it's a taxi. So really important to understand that there are these little differences in the way the legislation is worded between different areas of the tax system. And the ATO says that does have a pretty big impact when it comes to applying those different tax areas. For GST, you get one answer. From an FBT point of view, you get something slightly different. So that's the ATO. It sounds like they've concluded their review on this area and have said Uber and other ride sourcing services are not taxi for FBT purposes.
And from government, we're going to take a look at the raft of tax and superannuation changes that have been introduced into Parliament.
We've had the government introduce a number of tax-related bills to Parliament recently. Some of the bills deal with measures that go back a couple of budgets ago. Some of them are reintroducing measures that were previously before Parliament prior to the election being called. And in some cases, we've got things being introduced for the first time, but which flows on from some draft legislation that we've seen previously. Let's just run through some of the main tax-related measures and what the likely impact is going to be for clients. Now, the first thing is Everett assignments. Now, the government clearly not happy with the small business CGT concessions being used in connection with Everett assignments. This was an announcement made back in May 2018. And so this change is being backdated to that original date. Basically what the rules will say is that if you have a CGT event relating to an Everett assignment, so basically where you've assigned or created a right to receive income from a partnership, but that CGT event doesn't deal with the entire partnership interest. Where that's the case, often there'll be a CGT event. There may well be a capital gain that arises, particularly if we're applying the market value substitution rules with related parties involved. And what this change does is it says you will not be able to apply the small business CGT concessions anymore in relation to those types of events. If, however, you are disposing of your entire interest in a partnership or a full interest in the partnership, then you may still qualify for the small business CGT concessions. So it doesn't mean you can't apply the concessions to anything to do with a partnership. You just very much need to look at exactly what the nature of the transaction is. So that will be a retrospective change back to events from May 2018. The next one is changes to the rules around holding costs for vacant land. This change will apply from 1 July 2019, and basically we're looking at whether the expense has been incurred on or after that date. So there could be some clients who've held land for the last couple of years and they've been claiming things like interest deductions on the basis that that property is being developed to generate, say, rental income in the future. But from 1 July 2019 onwards, some of those clients will lose deductions for things like interest and other holding costs. Basically what these rules are aimed at is preventing those deductions from being claimed until the point where that asset is being used in a business or where a client is constructing a rental property. We need to ensure that that property can lawfully be occupied and is either actually being rented out or is genuinely available for rent. So major impact on people who buy land and will be developing rental properties, or where existing properties are bought and substantial renovations are being undertaken in relation to those properties. Now, as I say, there is an exception where the land is being used in a business, but there's some intricacies to the rules. We'll just have to have a look at the detail of that to see whether clients are affected or not. The next change relates to circular trust distribution. So situations where Trust 1 distributes to Trust 2 and Trust 2 distributes income back to Trust 1. There are already some integrity provisions dealing with that, but previously there's been a carve out for trusts that have made a family trust election. That carve out is being removed. So the government is basically saying it doesn't matter whether the trust has made a family trust election or not. If there is a circular distribution of income between trusts, well, that integrity rule penalty tax can apply regardless of whether there's a family trust election in place or not. That change will apply from 1 July 19 as well. The next one relates to super guarantee and salary sacrifice super contributions. Now, the way the rules work at the moment is that when an employee gives up some of their pre-tax salary in exchange for the employer making additional super contributions on their behalf, two things happen. First of all, the employee's salary has been reduced, which means that the employer's SG obligation or liability is reduced as well. But what also happens under the current rules is that the salary sacrifice super contribution counts towards determining whether the employer has met their SG obligation. So unless the employee and employer have reached some other agreement, or the employer has just decided out of the goodwill of their own heart to kind of make sure that there's no reduction in overall super being provided, employees can miss out, and sometimes they don't realise that they're actually missing out. This change has been talked about for some time, and the bill contains these changes. Look like we'll see changes from 1 July 2020, so it won't be an immediate start date for that one. But what it will mean is that employers may need to revisit whether they are correctly calculating their SG liabilities, and there may need to be some adjustments made to things like salary sacrifice agreements, just to make sure that the parties are aware of exactly what this change means. But there's a little bit of time to do that, 1 July 2020, before that change comes in. Next super related measure is where someone may have multiple employers and where they are having significant SG contributions being made for them. The risk in those cases is that someone could actually exceed their concessional contributions cap for a particular year because both of their employers are meeting their minimum SG obligations. What these changes will do is will allow an opt-out mechanism. So allow someone to actually apply to the ATO to ensure that maybe one of those employers doesn't have to make SG contributions, but you would need to apply to the Commissioner and explain the situation to make sure you've got permission for that opt-out to occur. The other thing mentioned just briefly is a number of changes are being made to ensure that directors kind of can't get out of sort of company liabilities tightening up areas around phoenixing companies, etc. But one of the changes that will have a potential impact on directors personally is an expansion of the director penalty regime. At the moment, that covers super guarantee liabilities and it covers PAYG withholding liabilities of a company as well. What the government's been talking about for some time now is expanding that to cover GST liabilities as well. So, assuming the bill passes, directors could be personally liable for unpaid GST liabilities of a company, in addition to unpaid PAYG withholding and super guarantee amounts as well. And depending on the sorts of activities and the sorts of numbers that are kind of running through a company, those GST liabilities could potentially be quite significant. So that is a potentially significant change for anyone who acts as a director of a company. There is an additional risk associated with acting as a director if this bill passes in the way that it's currently drafted. So it's quite a lot of tax-related changes that have been reintroduced to Parliament or introduced to Parliament for the first time. Various start dates for those things. A lot of clients are likely to be affected in one way or another, and we'll just have to wait and see how things progress through Parliament. But start identifying now clients who might be affected and the impact that it might have on them over the next little while.
Finally, the ATO guidance on compensation from financial institutions.
Now, the ATO has released some further guidance dealing with a situation where financial institutions are paying compensation in relation to poor advice or advice that was never received, etc. Now, previously the ATO had given some guidance in this area where compensation was paid to an individual. What the ATO has now done is provided some updated guidance or a new guide which deals with a situation where compensation is paid to a superannuation fund. And what we're seeing in practice is lots of individuals are receiving payments from financial institutions, but often payments are also being made to super funds as well. What the ATO says we basically need to do is start off by looking at what the compensation payment represents. Where the compensation payment relates to a loss of income, well, the compensation payment will generally be taxed in the same way that the income would have been taxed. So typically will be dealt with on revenue account. Where the compensation relates to an investment, a loss on an investment, what we then need to do is look at whether that investment is still held by the fund or whether it has already been disposed of. If the investment is still held by the fund, then what we'll need to do generally is to reduce the cost base or reduce the cost base of that relevant asset. And that would increase a capital gain on future sale or reduce a capital loss on future sale. Where the asset has already been sold though, prior to the compensation being received, well, the ATO says we need to treat that compensation as if it was additional proceeds for the disposal of the asset. It may be that a tax return has already been lodged declaring a capital gain or loss. Well, if so, we'll probably need to go back and amend that return, adjust the capital proceeds, and put in our new capital gain or loss figure instead. And that could have flow-on impacts, particularly if we're dealing with capital losses. Now, what that means is that we will, again, need to go back and see exactly what does the compensation represent. If it's income, we deal with it one way. If it's a loss on investment, we deal with it slightly differently. If, however, we can't tie the compensation to any particular asset or investment, but we know that it doesn't represent compensation for a loss of income, well, what we'll generally be doing there is dealing with it on capital account and treating that payment as if it was proceeds for the end of the right to receive compensation. So we'd have a separate CGT event that's being recognised and we would calculate a capital gain or loss from that. So that's what we need to do. As I said, the ATO has previously given guidance in this area, but focusing on payments received by individuals. And in that guide, the ATO also deals with a situation where someone is having advisor fees refunded. Again, just to reiterate what the ATO says there, the ATO is basically saying we need to look at whether those fees were deductible or not. If they were deductible, then typically the recoupment of those fees will need to be included in assessable income. If the fees had been added to the cost base of an asset, we'll probably need to make some cost base adjustments or maybe adjust a previous CGT calculation that we've already done. So we really need to look at the nature of the payment, as we often do with any sort of compensation payment that a client might have received. And then we get into the mechanics of, well, what impact does that have from a tax point of view? We've seen a lot of these payments being made already. I suspect we'll see quite a few more, so it's very likely you'll have clients affected by this at some point if you haven't already. Well worth taking a look at the ATO's guidance just to make sure that you're treating these payments correctly and ensuring that clients' tax returns are being prepared correctly as well.
Change is a constant in this profession, and to help you, the Knowledge Shop membership is there with a help desk, work paper updates, training and so much more. Why don't you take a look at what we've got to offer on knowledgeshop.com.au or give the team a call on 1800 800 232 and we'd really love to show you what we do. We look forward to speaking to you soon.